let's talk about valuing syndicates and the economics around this, right? We're all investors. We are economically interested creatures, and there's nothing wrong with that. So let's just address this topic head on. I want to start with the returns profile. We're going to talk about this from two perspectives. One is as an investor into as part of a syndicate, and then we're going to shift gears and also look at the perspective of the returns profile for all of you as prospective syndicate leads. So again, the proposition of a syndicate is deal by deal portfolio construction. So let's say you are an investor or one of your investors as part of your syndicate, and you are sharing this set of deal flows, A through F. Now, on the average deal, I'd say around 5 to 7% of the capital commitment goes towards fees, okay, or admin costs. And this will cover the SPV, the legal structure, and also management fee, which the syndicate lead takes as cash. So bear in mind, 5 to 7%, that is an acceptable range in my view. For simplicity, I'm just going to say 5% here. Which means that on the average deal, for every dollar committed, 95% of the capital goes towards these companies. And let's say, in this case, an investor invests in these three companies, B, D, and E out of the 6. Now, the investor obviously only gets exposure to deal level returns in the portfolio that they constructed. We are calculating returns above the 1x line. So even though 95% of capital is deployed, we are calculating returns only above the original 1x. In this case, this investor has done pretty well. Company B and Company E generates a return. Company D ends up being a loser. The investor returns is obviously going to be restricted to this, right? And the deal is this. Investors in each deal get 1x liquidation preference. So original capital back up till the time they are made whole. Above that, carried interest applies. So on 20% carry, they take 80 cents on the dollar. Okay, so this is what it's illustrating on the right here. On Company B and Company E, investors get original capital back and 80% of every dollar return above that. On Company D, that doesn't return that 1x amount, they get whatever capital is clawed back from the deal. So if we're shifting the perspective now from the perspective of the syndicate lead, we have these 6 deals, A through F. On each of these deals, we have 95% deployed on every single deal. Investors get to decide which ones to invest in, but we have exposure in all 6. And let's say on this portfolio, again, remembering that we are calculating returns above 1x. Only Company B and Company E returns above 1x, and let's assume that the rest go to 0 or return less than 1x. As the syndicate lead, you would take 20% carry on all the deals that return above 1x, and you earn 0 on the ones that don't. So in this case, you would take some portion of that 5% admin fee. Some of it will go to the SPV, and we'll take some in management fee. And on the 2 deals that return above 1x, we'll take 20% carry. And so this is what it represents. The point here is that on the deals that return less than 1x, the losses are capped, right? So they don't diminish the overall carry on your profitable deal. So in this way, one way to think about deal by deal syndicates is that every deal you do is a call option rather than classical portfolio theory. Now, if you are running a single syndicate and you do $100,000 raise, and to be clear, this is on the very, very low end. In the program that I teach, the syndicates that I work with, the aspiration that I set for everyone is that on your very first deal, you should be aiming to hit $100,000 raise or more. because anything less, it's honestly subscale. The SPV cost is too high. Your management fees aren't worth that much. The upside also isn't worth that much. It's a little bit of a dead zone, right? So you really want to go above 100,000 because that is minimum critical mass. Depending on where you are, the cost structure varies, but as a broad average, we can say the SPV, the structure, would cost around $3,500. If you're taking 3.5% management fee, this is one time upfront, not recurring, you would take $3,500 in cash, which means that you have deployed $93,000 of capital. If you are taking 20% carry, and I do encourage, advise, and insist on this, 20% carry is worth an $18,000, 600 capital position upside on the deal. Now, this is not free, of course. We have put in a bunch of effort on the fundraise, on the due diligence, and on the maintenance, the ongoing maintenance through the life of the vehicle. So this whole box here in red is our equation, right? What we're trying to do to maximize the upside and to keep the effort, the cost side of the equation de minimis. This is how we think about it. One interesting and compelling thing about syndicates, and this is something that I will refer to in other parts of this masterclass, is that there is an investor acquisition. It will grow over time without concerted effort if you are building the base right and doing the right things. So just hold on to that point, right? Take it as a given, and I will prove it to you during this session. If your syndicate grows, then these numbers grow. So we shouldn't be anchoring our view in this one deal, which is on the lower end, and indeed our very first deal. Let's take an upside scenario. At scale, if you are running a syndicate that's deploying, let's say, $3 million a year, right? And let's assume that that is 6 deals a year at roughly $500,000 check. It might sound a lot like when you're starting out, but it is possible. I've seen syndicates deploy millions of scale type of like capital into individual deals where we ourselves have hit 7-figure raises. At this scale, your SPV costs come down as a percentage. It actually would come down to maybe 2%, which means your SPV goes down to $60,000. If you're still taking 3.5% management fee, again, one time, upfront, non-recurring, it's $105,000 in cash, which means that you have deployed capital of $2.8 million, and the carry interest upside position on this is worth $560,000. So it's a much better scenario. We still have our fundraise and maintenance effort, but now this value, looking at this, looks a lot more attractive than that single $100,000 deal. Okay. The way I like to structure and optimize the economics on a syndicate is to set a maximum fee threshold for investors. Okay. And from my experience working with investors, it tends to cap out at 6 to 7%. Okay. So anything more than that, in that range, investors start to push back. They say the fee's too high, which I think is a legitimate argument. So I'm going to model out the scenario on a 7% fee threshold. This is covering both the SPV costs and also the management fee. So this chart here is showing on the bottom axis the amount of capital raised on a particular SPV. The red line, the orange line is showing the SPV cost in terms of percentage. And then the blue line is showing the management fee as a percentage of the raise. The point here is that as capital scales, SPV costs decrease as a percentage, and consequently, you can increase your management fee, the cash economics, and the view from investors is the same. Okay, so this is one way to optimize the cash component, right, by scaling up your average check size. In this model, on the $100,000 deal, the SPV at 3.5% would yield $3,500 would cost $3,500. The management fee, 3.5%, would yield $3,500 in cash. And so from the investor's perspective, the fee component is 7%. If we do a $500,000 deal, the SPV might cost only 2%, in which case you can increase management fee to 5%, which is $25,000. And from the investor perspective, it's still 7%. Right? So the point here is that as you scale average check size, not only do your carried interest economics increase, but your cash component also increases, right? So it benefits you two ways. Now, let's look at this in dollar terms, right? The full package of value looks like this. Same simulation, a $100,000 deal. You, as a syndicate lead, would be taking $3,500 in cash. You would have an equity position worth $18,000 or $19,000. On a $250,000 deal, you would get management fee of $12,500 and an equity position worth $46,500. On a $750,000 deal, it would be management fee of $40,000 and an equity position worth almost $140,000. Okay, so this is just showing the numbers here. That's showing the numbers here to give you a simulation. Of course, depending on where you are in the world, these numbers might change. And so this is just a general framework to look at this.